Welcome to our in-depth analysis of the EUR USD for the week of September 15th to 20th, 2025. In the next few minutes, we'll break down the key market-moving events, technical levels, and strategic outlook for one of the world's most watched currency pairs. This has been a pivotal week, with the Federal Reserve making its first interest rate move of the year, sending ripples across the financial markets. We'll explore how this decision, combined with news from the ECB and political developments in Europe, has shaped the landscape for the euro and the dollar. Whether you're a short-term trader or a long-term investor, this report will provide you with the critical insights you need to navigate the path ahead. Let's get started. First, let's establish the foundation of our analysis. All data has been meticulously compiled from trusted financial sources, including TradingView for real-time price information and expert analysis from Investing Live, Action Forex, and Daily Forex. As of the market close on September 19th, the EUR/USD was trading at 1.17440. This represents a daily decline of 0.35%, reflecting the market's reaction to the week's major events. The chart on the right paints a clear picture of the week's volatility. We saw a strong rally to a new 4-year high of 1.1919, followed by a sharp correction. This price action was driven by a complex interplay of central bank announcements and economic data, which we will dissect in the coming slides. Now, let's turn to the technicals. Despite the recent pullback, the bigger picture for EUR/USD remains constructive. Over the past 6 months, the pair has gained a significant 8.62%, and it's up over 13% year to date. This underscores a strong underlying bullish trend. The short-term indicators tell a nuanced story. The Relative Strength Index, or RSI, is hovering around 56. This is a healthy level, suggesting that the pair is not overbought and has room to move higher. The MACD, another key momentum indicator, is preparing to turn upward, signaling that buying pressure may be about to resume. Our overall technical summary is therefore neutral with a bullish bias. While the recent correction warrants caution, the primary uptrend remains intact. The chart on the right clearly illustrates the key support zone around 1.1770 to 1.1790, which has held firm, reinforcing the bullish case. To get a comprehensive view, we've synthesized insights from leading forex analysts. There is a broad consensus that the bullish trend remains the dominant theme despite the recent volatility. Greg Michalowski at Investing Live notes that buyers successfully defended the key 1.1832 support level, keeping them firmly in control. He sees the next major upside target at the 1.1909 double top from 2021. Action Forex highlights that the post-FOMC sell-off is likely a minor corrective move within the ongoing uptrend. They emphasize that the EUR/USD hit a 4-year high of 1.1919 before the correction, signaling strong underlying momentum. Mahmoud Abdallah at Daily Forex maintains a still bullish outlook, stating that stability above the 1.1800 level will continue to be a catalyst for bulls. He identifies key resistance levels to watch for further upward breakouts. Across the board, the message is clear. The recent dip is seen as a temporary setback, not a reversal of the primary uptrend. Now let's delve into the fundamental drivers of this week's price action. 3 major news events shaped the market narrative. First and foremost was the Federal Reserve's decision to cut interest rates by 25 basis points. While a rate cut is typically bearish for a currency, Fed Chair Powell's accompanying press conference was less dovish than expected. He described the move as a risk management cut, which tempered expectations for a long-term easing cycle and led to a recovery in the US dollar. Second, we had commentary from the ECB. President Lagarde hinted that the Eurozone's rate-cutting cycle might be over. This created a policy divergence with the Fed, providing underlying support for the euro. Finally, political news from France added a layer of risk. Fitch downgraded France's credit rating, citing political turmoil. This news weighed on the euro, contributing to the downside pressure. With the fundamental picture established, let's pinpoint the specific price levels that traders are watching. These are the battlegrounds where bulls and bears are fighting for control. On the upside, the immediate resistance to watch is the 1.1890 to 1.1919 zone. This area includes the recent 4-year high and a significant double top from 2021. A decisive break above this ceiling would signal a continuation of the bullish trend and open the door to higher targets, with the next major resistance cluster around 1.1970 to 1.2050. On the downside, the key short-term support is the 1.1770 to 1.1790 area. This level has held firm during the recent pullback and is now a critical pivot point. As long as the price remains above this zone, the bullish outlook is intact. A break below, however, would signal a deeper correction, with the next support levels to watch at 1.1720 and then 1.1680. So, how can we translate this analysis into actionable trading strategies for the short term? Here are two potential scenarios for the next 1 to 2 weeks. For the bulls, a potential long strategy would be to enter on a dip near the 1.1770 to 1.1790 support zone. The target would be the recent highs around 1.1890 to 1.1919, with a stop loss placed at 1.1720. This setup offers an attractive risk-reward ratio of approximately 1 to 2. For the bears, a short strategy could be initiated if the price fails to break above the 1.1919 to 1.1920 resistance. The target would be a return to the 1.1800 to 1.1770 support area, with a stop loss at 1.1970. This trade offers a risk-reward ratio of about 1 to 2.4. As always, keep a close eye on the key events that could impact these strategies: the market's ongoing reaction to the FOMC, any new commentary from the ECB, and upcoming US economic data. Zooming out to the medium term, over the next 1 to 3 months, we see a higher probability of continued bullish momentum. Our base case, with a 70% probability, is that the EUR/USD will target the 1.2000 to 1.2100 range. This scenario is contingent on the Federal Reserve continuing its easing cycle, the ECB maintaining its current neutral to hawkish stance, and US economic data showing continued moderation. The recommended strategy in this case is to buy on dips, particularly around the 1.1700 to 1.1770 support area. However, we must also consider the alternative. There is a 30% probability of a bearish scenario, where the price could fall to the 1.1600 to 1.1500 range. This would likely be triggered by the Fed signaling a pause in its easing cycle, the ECB turning more dovish, or an escalation of political risks in France. In this case, the strategy would be to sell on rallies if the price fails to hold above 1.1800. Finally, no analysis is complete without a thorough risk assessment. On the upside, a more aggressive Fed, a sharp deterioration in US economic data, or a hawkish surprise from the ECB could all push EUR/USD higher than expected. On the downside, the key risks include a more hawkish stance from the Fed, an escalation of political instability in France, and unexpectedly strong US economic data, which would reduce the need for further Fed easing. The risk matrix on the right helps to visualize the potential impact and probability of these factors. As you can see, the highest probability risks are currently political instability in France and strong US economic data. To navigate this complex environment, we recommend strict trading discipline. Always use stop losses, consider smaller position sizes around key events, monitor central bank communications closely, and be prepared to adjust your bias if the price breaks key technical levels. Thank you for joining us for this analysis of the EUR/USD. We hope this report has provided you with valuable insights to inform your trading decisions. Subscribe to our channel for more in-depth market analysis.